In the mid-2010s, WeWork burst onto the scene as a revolutionary startup, determined to redefine the way people work. Founded in 2010 by Adam Neumann and Miguel McKelvey, the company promised to transform traditional office spaces into vibrant, community-driven environments that foster creativity and collaboration. With a mission to create a shared workspace lifestyle that combined productivity with a sense of belonging, WeWork quickly became a poster child for the future of work. The company's early success was nothing short of spectacular. WeWork rapidly expanded its presence across major cities around the globe, from New York and London to Tokyo and Berlin. Its innovative concept captured the imagination of a new generation of entrepreneurs and freelancers who craved flexibility and modern amenities. Backed by a wave of investor enthusiasm, WeWork's valuation soared to an astonishing $47 billion in early 2019. At its peak, the company signed long-term leases for office spaces in over 800 locations and attracted millions of members, positioning itself as a leader in the co-working revolution. Yet behind the glittering promise of innovation lay a foundation built on risky financial assumptions. WeWork's aggressive expansion strategy was fueled by massive capital injections, particularly from high-profile investors who believed in the company's boundless growth potential. However, this rapid scaling came at a steep cost. The business model was based on long-term lease commitments, while revenue was generated on a month-to-month basis from its members. This mismatch led to enormous fixed expenses that the company struggled to cover, even as its revenue numbers continued to climb. In 2018 alone, WeWork reported losses that dwarfed its earnings, highlighting a critical vulnerability in its business model. Matters took a dramatic turn when WeWork began the process of preparing for an initial public offering, IPO, in 2019. As the company filed its IPO paperwork, the market started to scrutinize its financial practices more closely. Investors and analysts were shocked to discover that the impressive growth was largely underpinned by aggressive accounting practices and an unsustainable cost structure. The filings revealed massive long-term lease obligations and questionable business decisions, including self-dealing by founder Adam Neumann. His controversial actions, such as leasing buildings he personally owned to WeWork and trademarking the word "we" for personal profit, raised serious red flags about the company's governance and ethical practices. The resulting backlash was swift and severe. Within weeks of the IPO filing, WeWork's projected valuation was slashed by over 90%. Investor confidence evaporated, and the company was forced to postpone its IPO indefinitely. Under mounting pressure from major investors, Adam Neumann was ousted from his role, and a series of drastic cost-cutting measures were implemented, including laying off thousands of employees and renegotiating leases. However, these steps were not enough to stem the tide of financial losses. Then came the COVID-19 pandemic in 2020, a crisis that struck at the very heart of WeWork's business model. With lockdowns and a sudden shift to remote work, demand for shared office space plummeted. WeWork's occupancy rates fell sharply, and its revenue stream dried up almost overnight. The company, once a shining beacon of modern work culture, found itself struggling to survive amid a global health crisis. The financial strain was so severe that by mid-2020, WeWork was forced to seek emergency funding and restructure its operations. Despite a desperate bailout effort by a major investor that injected billions of dollars into the company, WeWork's underlying issues proved insurmountable. The once high-flying startup, which had been celebrated for its rapid growth and transformative vision, had become a cautionary tale of unchecked ambition. By late 2023, WeWork filed for Chapter 11 bankruptcy protection, marking one of the most dramatic collapses in startup history. The company's assets, once valued at $47 billion, were restructured under new ownership with a valuation of less than 1% of their peak value. The story of WeWork offers a rich tapestry of lessons for entrepreneurs, investors, and business leaders. It teaches us that a compelling vision must be matched by solid financial fundamentals, and that rapid, unchecked expansion can lead to a precarious future. The WeWork saga underscores the importance of transparency and robust corporate governance, as well as the need for a business model that can adapt to changing economic conditions. Even the most dazzling ideas can fall apart when the realities of long-term commitments and unsustainable costs come into play. As we reflect on WeWork's journey, from the heights of a $47 billion valuation to the depths of bankruptcy, the tale serves as a stark reminder of the risks inherent in the tech startup world. It also prompts us to consider the true value of innovation. Is it enough to simply generate hype, or must it be grounded in realistic, sustainable growth? What lessons do you take from WeWork's meteoric rise and catastrophic fall? Share your thoughts in the comments and subscribe for more deep dives into the most compelling business stories in tech